Hello, friends.
Yes, sir.
Am I audible? Selva, Kunal, Janji. Hi, Sanish.
Yes, sir.
Audible and visible, no, Sanish?
Yes, audio visible, sir.
Yeah, thank you. Let's allow your friends to be joined within couple of minutes and we shall start. How's the learning going on, Betsy? Betsy, are you there? How's the learning going on?
Yes, sir. Well, sir.
Thank you.
Could you see my videos? I know that.
No, no, Selva. You may rejoin. Video is not visible right now.
Let me try.
Mr. Saud Bachne, have you joined for the first time, man? Or have you been to the classes before? Mr. Saud Bachne. No response. No worries.
Hello. Yeah, this is
Yeah.
Saud Bhatni. This is my first.
Okay, Saud. Welcome to the class and hope you will be having a value added session today. Do give a feedback after the class,
Thank you.
okay?
Thank you so much.
Okay, all the best.
Yeah, sure.
Yeah. Okay, guys, enough. Let me share my screen. In the meantime, people will join. It's okay. So let me share my screen and check. Athira, would you be able to allow me to join? Sorry, allow me to share my screen. You have disabled my screen to be shared. Athira,
I tried my video, but it is not yet able to
it's
connect.
okay. It's okay, Selva. It's okay. No worries. Athira, would you be able to allow me to share my screen or make me a co-host? Athira, are you there? Or anybody from the management end? I'm not able to share my screen. If you could please allow me that. Guys, let's wait
Done.
for.
It's done.
Yeah, thank you. Yeah, now, thank you. Okay, great. So here we go. All of you could now see my screen. It is a PowerPoint slide. You might see the blue background. Yes or no?
Yes, it is visible.
Yes,
Yeah,
yes, yes.
yeah,
Yes.
thank you. So here we are going to learn that now the real world computations which shall be started in order to understand that yes, we know we learned about the standard deviation, variance, the average, mode, median, and all stuffs with respect to the statistics. But what is actually happens is a bit different from it. Why? Because you know in the real world things are changing at a faster rate, and that's why I have chosen this topic in order to continue for our upcoming lecture series, such that we will be able to use the data with respect to the streaming data, the data Okay, and do anybody have a understanding about the static data and the streaming data? Anybody? I'm asking about the static data and streaming data. Do you know the difference between them? Anybody?
No, no.
Okay, try, at least try. See the name. Static means something which is static, not moving. Anything which is, may I say, not moving. Am I correct by the term static? So the data which is kept idle, the data which is kept just not changing at any moment of time, means if I say I draw a curve with respect to time and the data, mind it, the data is static. Data is not changing with time. This is the type of curve I'll be able to draw for static data, my dear. But when I will say streaming data, the streaming data says it is changing data. Data is changing. Okay. And if the data is not changing, the evaluation is changing with respect to the data. Like, say, you are having a big billion sale, big billion day offered by either Alibaba website, or say Amazon, or you may go for ask for a Flipkart. Especially in India, these are the e-commerce website which are good for means big billion days, and people shop a lot on these days. So don't you think, as the number of people are interacting with the websites, doing a purchase, taking out the things, and inventory is changing at the faster rate? Say suppose there are 5 million user 5 million user on a given website on the big billion day, and every second 5 million users are purchasing something. So this purchase is actually happening live, mind it. It's happening live, and that's the reason, if it is happening live, the inventory data shall change, yes or no? Inventory data means where the product details are kept, yes or no? Product details, like say somebody
Yes.
has 5 lakhs mobile phones, 5 lakh mobile phones, and 5 million users are directly hitting the purchase button. So this 5 lakh is decreasing at a faster rate. So your inventory is lessening, your inventory is de-augmenting. It is getting changing every time, and hence such a data will be called as dynamic data, changing data, dynamic data, or we call it as a streaming data. So in order to comprehend or understand the nature of such a streaming data, we use the term exponential moving average. Mind it. Let me clear it. It is all ink on the slide. So we are using the term exponential moving average. So before understanding exponential, we should understand what is meant by moving average, because we know what is an average. Yes or no? We know what is an average. That is the addition of all the data points x of I is equals to 1 to n, I equals to 1 to n, whole divided by total number of items. So this is an average. But if I talk about moving average, can you imagine how the average is moving? Anybody? Yes, Silva, want to say something? Would you be able to imagine how the average is moving, or how average can move? Sanesh, Betsy, Zobin, Abdauji, Rajiv, Asif, Jan Mithai,
Yeah, the
anybody?
total amount is decreasing. So average will also coming down.
That was the inventory, Janji. That was inventory that was actually decreasing because purchase was happening. I'm asking, if this is an average, this average actually happens over the static data. But if I ask how it is moving, how would you feel like when average starts moving? When average starts moving, any idea about this?
No.
Okay. Actually, Okay. Any idea about if you have worked in or did certain purchase in a stock market? Have you seen certain candles in the form of red and green? We candles are formed as a red and green candles, which shows whether the market is up or the market is down.
Graph.
Yes, graphs. You must have seen the stock market kind of candles or line chart, which is going up, sometimes down, sometimes static. So these are actually showing, if I at least have this. Okay. Are you able to see these candles here on the right hand side? How these candles are changing? Yes.
Yes, we can see. Yes.
Yeah, this one
Yes.
depend upon the market.
Yeah, but that is correct. It depends upon the market. But if you want to trade, if you want to take a bet on the market, won't you use certain indicators? Yeah.
Yes.
Say, suppose market has a very fair rule. If I use a different color, it says, market says profit is equals to selling price minus cost price. Means if you buy at low, and sell it high, then only selling price minus buying price will end up to profit. Then only you would be happy. Then how would you decide that what is the low point, and at the point you have bought it, the market will go up? Yes or no? That
Yes,
might
sir.
happen. Suppose,
Yes.
Yes, yes, yes,
suppose,
yes.
suppose Selva, if happened at this point you bought something, at this point you bought, and now you thought, okay, the market has already crashed. Now the time has come when the market will correct itself to up. But unfortunately, the market crashed further. So your buying point is higher than that of your any of the selling point. So in order to indicate where to buy, where to sell, or how to interpret the market, we use something which is called exponential moving average. By the time we had understood the average only, but right today we will understand moving average, and in our upcoming class we will understand exponential moving average. So moving average is a term which we are required to learn and implement latest by today. Let's see how. So here the moving average says, these are the three things about the moving average. It says moving averages help smooth out the fluctuations in time series data, revealing underlying trends and patterns. Okay, that is the, may I say, nature of the moving average. But have you ever thought about the what is meant by time series data? Time series data. If you see in the background, some green candles, some red candles are being formed. So as per the time is changing, if I draw it for you, as per the time, the, may I say, the price is changing. The price of a product, suppose if I write price of a product is changing as per the time. So say suppose in uh, in the month of June, I have a price at this point. In the month of July, the price is boomed at the another point. In the month of August, the price again dropped down, and in the month of September, let me choose the color. In the month of September, the price has again went up. So see how the price is changing. Price has changed. So this is called time series data. With respect to the time, if the y-axis, mind it, if the y-axis is changing, we will say with respect to time, the change in the vertical axis is representing time series data. Simple. Time series data. Data means something is there in x and y axis. Series means that the data is in continuation changing, and time means with what respect it is changing, with respect to time it is changing. Okay, you might see that if you book a flight, if you go on booking a flight tickets, the flight ticket varies. Say suppose you are booking to book for India, you want to come from Abu Dhabi or Qatar to India. You check the flight. Sometimes the flight ticket goes 18,000, sometimes it goes 22,000, sometimes by luck it went to 15,000. So you book at that day or the time if it allows to you. So what is this? This is the data which is changing with respect to time. So likewise, there are certain indicator which actually changes as the average is changed. So say suppose if you are having the data like I would give you the proper implication that okay, you have sales data, in which sales data say you have 7 weeks sales data. In the 7 week sales data, for the first week some sale has happened, say 49 lakhs rupees, say data is in lakhs INR. So 49 lakhs of business is done. Then say suppose 50 lakhs is done, then 39 lakhs is done, then 64 lakhs. So every week the sales data is changing. So if you are able to calculate their average, it will come static. But if you want to only check, if you want to make your average moving, you have to select the time period. Like if I say, what was the average for the last, say, 2 weeks? What was the average for the last 3 weeks? What was the average for the last 4 weeks? So don't you think if you calculate the average for the 2 week, if you calculate the average for 3 and 4 weeks, the average would be different, yes or no?
Yes, different.
Different. Why? Because see here, 49 and 50 will make an average of 49.5. For 3 weeks, 49, 50 and 39 will make an average around say 45. For the 4 weeks, 49, 50, 39, 64 makes an average about say 54. Okay. So if you take as many points, so many averages will come. So may I ask now, if these are the average values, isn't it changing? See,
Yeah,
isn't
yes.
it changing?
Changing.
Yeah. So if these averages are changing, Genji, then may I say, if I draw my average line, say here only, if I change the color and try to draw my average line. So say initially it was 49.5. So say average 49.5 is here. Next time the average is 45. Say my average went down. Then next time it went 54. Say my average went up. So I would be able to draw my parallel line against the trend. So this average, or must I say moving average, is going to help me to decide whether should the trend is going up or down. Agreed or no?
Yes.
Yes. So this is how you should try to interpret that yes, how the market is changing. Why I'm saying so? A few of you might be doing the trading. Few of you might have opened the, say, what is called that demat account. We call it demat account, dematerialized account. We call that. So in short, demat account, such that we could purchase the stocks of a good reputed company and we can sell them, making a short term or a long term capital gain out of that. So there we only select the instrument. From that instrument, we select what type of moving average we want to select. Then we select exponential moving average from there. And then we add the value that what is the exponential moving average would you like to consider? Is it a 5 days? Is it a 1 day? Is it a, say, 1 week? Is it a 1 month? What type of moving average would you like to have? Or what type of chart you are in? So there you have an actual implementation. So I'm not guiding you to do the trading. I'm just helping you to interpret what do you do when you select the instrument as a moving average there. Okay. So likewise here it is told short versus long term. So the length of the moving average window determines whether it is capturing the short term window or a long term trend. What does this mean? See the term short versus long term. So if I am selecting moving average as a say 5 minute, moving average as a 15 minute, moving average as a maximum 1 hour. Okay, if I'm choosing them as a moving average, I am going for a short term goal or a short term plan or a short term strategy. But if I want to do investing, suppose if I want to invest my money for a longer term, say 5 years, 3 years, 7 years, I'll be choosing the moving average of at least 1 day, of at least 1 week, of at least 1 month. Do you all agree? I'm giving you a direct interpretation of what is meant by long term and short term. Oh, by the way, if I ask,
Yeah.
all of you would have invested in your life, yes or no?
Yeah.
Yeah, yes.
Yes. So if we all have invested, few of you, because you guys, few of you are in a good age, few of you are in a younger age. So those who have already crossed 45 years of your life, you might have been believed in fixed deposit, recurring deposit, gold, may I say, or say bonds given by the government, or sometimes some other debt funds. Okay, debt funds. So this is few of the sure short thing. But if you are good to take, may I say, what do I call that term as a risk? If you have a good risk appetite, you might go for mutual funds. Yes or no? Mutual funds. You might select index funds, or if you are quite pro in something called a stock market, you may go and select direct stocks, that you believe it is doing a good business in. So these are the things where we select if we want to invest for coming 5 years, coming 10 years, coming 15 years. Say you want to invest for your baby or your child, for his or her future income, or may I say his or her education. You are investing for the education, you will be definitely going with the uh, long term
Long term.
moving average. And if you are only doing a trade, like okay, I have to get in, I have to do certain good profits, say 1%, 2%, 3% profit, and come out of the trade, then you will go for a short term. This is the motive of this class, that how would you be able to interpret, okay, if it's a long term plan strategy, or you are going for a very short term ability to uh, do the business. So this is what it is all about. Say suppose if I clean my this is, there is something called simple versus weighted moving average. Mind it, simple versus weighted moving average. So if I add term simple, it is simply a moving average. Nothing is added or subtracted from it. Whereas, do you remember we had learned about the weighted average sometimes back? Yes or no? Janji, Sanesh, we had studied weighted average. When we had started our measure of central tendency, we learned about mean, median,
Mean,
mode.
median, mode.
In there, Sanesh, we learned about weighted mean. Yes or no?
Yeah.
Anybody else remember that? Weighted mean, where we had seen that suppose you are having 5 numbers, say 10, 20, 30, 40, and 50. If you take a simple mean, you simply add them up and divide by 5, simple. But if you take a weighted mean, you will have weights to you, like 0.1, 0.2, 0.3, 0.4, and 0.5. Say suppose you have weights distributed like this. So you will be multiplying your recent, or may I say the highest number, by the highest weight. So you will be multiplying 50 into 0.5. You are giving 50% weightage to the highest number. Then 40 into 0.4, 30 into 0.3, 20 into 0.2, and 10 into 0.1. So what is the answer shall come? This comes as around 25. This comes around 16. This comes around 9. This comes 24. This comes around 1. So when you add them up and then you divide by 5, 1, 2, 3, 4, 5, this would be a different mean than only addition of them and divide by 5. Yes or no?
Yes, yes.
Yes. So here, when we talk about the moving averages, we will also consider that what weightage should be given to which value. If there is something which is occurring in a very recent, say suppose you have 25,000 entries, 25,000 entries are there, and you are supposed to have, say suppose 10 weights, you have only 10 weights, it only means that you are only going to take 10 weighted moving average, 10 weighted moving average. Why 10 weighted? Because you only have 10 weights and you can give weightage to the latest 10 entries, latest 10 entries. So you will be able to take only the 10 entries as a latest one. It depends on the number of weight you are having. Simply as it says, simple moving averages give equal weight to all data points. Mind it, this simple moving average, like what we had done here, adding them and dividing it by 5, it has given same weight to all the all the averages, all the values, sorry, all the data points. Why? We are multiplying by 1 only. Can you see? Only 1 is getting multiplied. But here we are giving different weights to different number. This is a partiality and it is correct. It is used to be given in time series data, in moving averages, while the weighted moving averages assign more importance to the recent observation. See the keyword. This is your keyword. Sooner is the entry received, sooner is the observation received, that will be given the higher weightage. Mind it, that will be given the higher weightage. So we shall learn how to calculate the weighted moving average and then apply it to our, say, real time series data. And then in our upcoming classes, we shall continue with exponential moving average. Is it good to go? Should I move ahead? Any doubt till this point? Yes, guys.
Okay.
Yes, sir. Go ahead.
Okay. Thank you. So here it says simple moving average. We know that what is the simple moving average means. How does it work? SMA is calculated by summing the last n data points and dividing it by n, where n is the chosen time period. Because right now we are dealing in time series data. Time series data. So the important thing is the time. Time can be calculated in terms of days, in terms of weeks, or in terms of months, sometimes years also, sometimes years also. So a new data comes in, the oldest data point is dropped and the average is recalculated. The average is recalculated. What does that mean? It simply means, say we have a data around 54, 55, 47, 39, 72, 55, 51, 50, 48. So likewise, if we have a data and if we are calculating, mind it, we are not only calculating simple average, but we are calculating simple moving average. That average should move. So how to move it? Say if you are considering 5 days, so initially your first moving average shall only come, mind it, your first moving average only comes after the 5 days entry has done. Say suppose if I ask you, this is the data, and if I am asking you to calculate the moving average for 5 days in this column, for 5 days moving average, would you be able to calculate at this moment the 5 days moving average? Yes or no? Guys, would you be able to calculate 5 days moving average here? Selva, Sanesh, Janji, Saud? No, because we don't have data. We don't have 5 data points. Here?
Same.
Yes,
No.
same. No. No. Here?
No.
Arey, we have 5 data.
Sorry, 1, 2, 3, 4. Yeah. Here.
Yeah, 1, 2, 3, 4,
3,
5.
4, 5.
So
Yeah.
so here we'll be having our first
That.
SMA. First SMA. Here, when you have your this data here, then you will be having your recent entry. Mind it, recent 5 entries will be calculated, and your second SMA will be calculated. At this point, you will be having your recent 5 entries, and third SMA will be calculated. Here, you will be having your recent 5 entries, and fourth SMA will be calculated.
No.
Understood well?
Yeah.
So it is a simple average, but moving with respect to time. So as broader time you take, you will need that many data points. But if you don't have, you may take a smaller data point. Okay, you may take a smaller moving average. You may go for 2 days moving average, 3 days, 4 days, 5 days. But if you're having a bunch of data, please go for a good one. And why I'm saying a bigger data or a bigger time moving average? Because this bigger time moving average will allow you to, may I say, neutralize the fluctuations. Fluctuations means, say suppose sometimes the data went like this. Sometimes data went in, went up, went in, went up, went in, went up. Can you see the fluctuations?
Yes.
So
Yes.
these fluctuations shall be removed if you take a bigger time slot. But if you don't have that much of data, it's okay to go with a smaller time slot. That is the reason when you go for investment, my dear, when you go for investment, you take at least 1 year data, 1 year moving average. What does that reflect? That in the past 1 year or every year, how does the particular fund is working? How does the particular fund is performing? It helps you to take a decision. That is the reason we choose moving averages. Then if I take you to the calculation, hereby I have already done the calculation to save the time. So this calculation says, if I choose the, okay, if I choose a different color. So here we have a 7-week data. Can you see? 7-week sales data we have. And this is the literally sales data, say suppose in lakhs. And I have taken 3-week moving average. So 3-week moving average, I'm not, and mind it, if it's a 3-week, I won't be able to go for the 3-week. I have to start from the 4th week. And here I have purposely chosen, mind it, in the past, we had started with the 5th point, but here I had started with the fourth point, because sooner the third point is over, mind it, sooner the third point, 3 points are done, we will be having with the fourth point. And still if we don't have, at least we are done with our 3 points. So sooner you are having the third point, you start taking the moving average. So how it is done? 39 plus 44 plus 40 divided by 3, we calculated 41. So we written the 41 here. Then 40 plus 45, sorry, 44 plus 40 plus 45, when they are added and divided by 3, we found 43. So we had written 43 here. And likewise, the data is prepared. This is how we have literally prepared the chart of a moving average. Now it is quite easier for you to understand. Till this point, no problem, I believe. But what shall we do after the 3-week moving average is calculated? The question comes here. There we are again motivated to calculate the error term, the difference term, the deviation term. So this error is actually a difference between the sales value, mind it, it is a difference between a sales value and a moving average. Okay, let me write it. It's a difference between a sales minus moving average. Can you see? Sales is 45 and 41. Answer is 4. Difference. 38 minus 43 minus 5. 43 minus 41 plus 2. 39 minus 42 minus 3. So this error is actually the difference between the sales and 3-week moving average. So this is error. But if you remember in our machine learning algorithm, and even not in a machine learning, in the statistics, we learned something about error term, which we call it absolute error. Absolute error. Hope you remember the absolute term. We used to take the modulus. This is the modulus. So whatever term comes inside the modulus becomes positive. 4 is positive, already a positive. Minus 5, when you have applied modulus to minus 5, it turned to plus 5. Similarly, when you applied modulus to minus 3, it turned to plus 3. Means whatever term you apply the modulus or the absolute function, it becomes positive. Okay. Therefrom, we calculated the square of the error. So this is called the square of the error. You will see that why such things are being calculated. So you did the square, 4 square 16, 5 square 25, 2 square 4, 3 square 9. Then what is the benefit? Now, if you remember, we had calculated sometimes back, we call it mean absolute error, mean, if I say mean MSE, remember? Mean squared error, mean square error. What does that mean? What does that indicate? That if you are having an absolute error, you add all of them, and divide by total number of quantity. So you added them, it came out to be 14, and you divide it by 1, 2, 3, 4, divide by 4, it came out to be 14 divided by 4 came out to be 3.5. So here the mean absolute error will come out to be 3.5 units. Yes or no? Is this understood? Selva, if you can mute yourself, background noise is coming. Selva, if you can mute yourself. Guys, have you understood how the MA is calculated? Yes or no?
Repeat once again, please.
Sure, Jen. See, absolute error is done, that we have taken the modulus and things become positive. Okay, things become positive. But now we have added them all. We have added them all here. We have added them all. 4 plus 5, 9, plus 2, 11, plus 3, 14. Okay. 14. And because this is the total absolute error, if you divide it by total number of terms, 1, 2, 3, and 4, if you divide by 14 by 4, here, if I divide 14 by 4, what shall I get? 4 3 is 12, and 4 3 is 12, 4 5 is 20, 3.5. I'll get 3.5 as my mean absolute error. Yes or no?
Yes, yes.
This
Okay.
is what I am saying. Hope you can see. 14 divided by 4, 3.5. Similarly, mean square error we will calculate. We all have a square of the error, 16, 25, 4, and 9. If you add them up, it counts to be the 54 as a total square error. If you divide it by 4, you will get mean square error, that the value is 13.5. So your mean square error is
13.5.
13.5. Great. And this is called the percentage error. The percentage error says you are having the error term 4. You have placed it here. Can you see 4? You divide it by the actual sale. This 45 is the actual sale. Can you see? This is the actual sale. So you have the error term, the deviation from the sale to the moving average. So the deviation divided by actual sale will give you the per unit error. Mind it, per unit error. And when you multiply that by 100, let me show it here. 4 is the error term, the deviation. Total is the sale value is 45. If you multiply it by 100, it becomes percentage error. So if you calculate it, it becomes 5 9 ja 45, 5 20 ja 100. So this is calculated as 4 2 ja 80 by 9. 80 by 9 turns out to be 8.89%. Is it understood?
Yeah, yes, yes.
So similarly, we will be taking every term like 5 divided by 43, 2 divided by 41, 3 divided by 42. See, we are dividing their sales. We are dividing the deviation term by their week sale, not the only week sale, by their respective week sale. It is not like I am dividing 4 by 45, so I am also dividing 5 by 45. No, I am dividing 5 by 38. Can you see here? 5 by 38. Because the difference 5 has come from the 38. Let me clean this, what I have written. So see, can you see here? This 5 by 38 has come from this 5 error term and the respective week sale. Can you see? Hope it is understood. Similarly, 2 divided by 43. 3 divided by 39. So that's the reason these percentage errors will come as their percentage loss, okay, or may I say percentage change. Loss is not a correct term here. Percentage change in that week. So here the percentage change is around 9%, 13%, 4%, 7.7%, and the total percentage change for the last 7 weeks is 34.4%. And if you go for their mean, taking again the average for it, so see, it is mean absolute percentage error. Can you read it out? MAP, MAP, mean absolute percentage error. So we call it MAP. And it has come out to be 34.39 divided by 4 is 8.6%. 8.6%. Is this table understood or no?
Yes.
Okay, thank you, South. You are being in the first time on this class, so it's an appreciation that yes, you understood it well. And here it actually shows that, okay, we tried for the 7-week sale, for the 7-week sales, over the 7-week sales, we calculate the 3-week moving average, we calculate the deviation, we calculate the absolute values of the deviation, we squared the deviation and calculated the percentage of the deviation, and then we found mean of everything. So we called it as mean absolute error, we called it as mean square error, and we called this as mean absolute percentage error. This was the thing we did till this point. Should I move ahead?
Yes, sir. Okay.
Thank you, Sanesh. So if I move ahead, I can say, then again, there's a term called weighted moving average. So this weighted moving average is actually, just try to understand here. Weighted means we already know that we will give different weights to different data points. Different weights to different data points. So how does it understood? The first thing says adjust for trend, means the weighted moving average assigns higher weights to more recent data, allowing it to better adjust to the changing trend in the data. Say suppose, what does it mean? Say the trend is going likewise. Now you are standing at this moment. You are standing at this moment. And now you have been given weights and a data, moving streaming data of a time series. So if you give higher weight or a higher importance to this data, the recent data, and lesser importance to the past data, so you will give less importance to this data, the past data, this is the past data, and high, Isaiah, please mute yourself. High importance. Isaiah, mute yourself. High importance to recent data. So what they are doing exactly, that if you give a higher weightage to this, you are with the trend. And if you give low weightage to this, you are definitely with the trend, but you are not dependent upon the past data solely, but you are likely to be dependent, more likely to be dependent upon the recent data. So you are with the trend. So you would be able to predict the trend based upon the current sentiment. What is the sentiment of a buyer or a seller, whether the buyers are dominant or a seller are dominant. If I give you the sentiment analysis, here buyers are dominant. Here nobody is dominant. Again, a buyers are dominant. See the arrow. Here sellers are dominant. Sellers are dominant. Again, buyers are dominant. Buyers, buyers, buyers. See, sellers are dominant. Can you see? When the trend is going down, we say sellers are dominant. So at this time, we will give higher weightage to sellers, because trend is the friend. So if you give higher weight to sellers, then definitely the trend is going to go down. But yes, Muzammil, great. But if you are lying in this phase, buyers are dominant. Uptrend, very good. Buyers are dominant. So you will be giving higher weightage to whom? To whom you will give higher weightage? To buyers. Does it make sense now? The meaning of weight, the higher weight, lower weight, and the trend. Is this understood? Oh,
Yes, sir.
thank you.
Okay.
Thank you. Yeah, thank you. So if I clean this, I will come to the next point. So here we had adjusted with respect to the trend. We adjusted with buyer. We adjusted with seller. Reduce the second importance of weighted moving average, or we call it WMA. Weighted moving average is the reduction of the noise. So by weighing recent data, by giving higher weight to the recent data heavily, the weighted moving average can smooth out the short-term fluctuations. Hope you remember, we discussed the fluctuations part. The fluctuations part. So these fluctuations which are coming when the trend is forming. So if you give higher weight to the recent data, these fluctuations shall be smoothed. Okay. So in the upcoming, in the upcoming trend, these fluctuations which were previously happening like this, in the upcoming trend, it will happen like this. Okay. See the fluctuations. See the amplitude of the fluctuations, how they are reduced if you had considered WMA. This is the meaning. Hope this is well understood.
Yes, sir. Yes.
Reducing noises and provide clearer signal for the underlying trend. Actually, what happens, see here, if I take you to the previous one, say here, let me clean it. Can you see if I take a red color? See here, at this moment, the trend is clear that it is going down. Can you see? The trend is going down. But here, the trend is sideways. The trend is sideways. We don't know whether it will go down or it will go up. So here, in order to make it a very clear picture, like this, can you see the trend here? Like this here, this phase of the trend, this phase of the trend. See the line curve. See the line, the lines which are passing by. So they are very clear that, okay, the trend is going down, 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 and down. But if you take a few portion of this trend, and if you focus here, say suppose you are lying at this moment of time and you don't know what is the next picture, you don't know what will happen, then at this moment of time, you might anticipate, my dear, you might anticipate that from this point, the trend might go up. Yes or no? Trend might go up or trend might fluctuate. There might be a possibility that trend again continue with that lower trend. So these are called fluctuations. These are called fluctuations. So these fluctuations are smoothened and give clear picture about the trend, whether the trend is downward or upward. And actually in the market, it never happens that there is a fall, and fall. When there are sellers, somebody is buying also. That's why the sellers are selling. There would be a point when buyers are equal to the sellers. So there, the fluctuations has to be there. And at this moment, if the sellers again dominates, again it will go down. But if the buyer dominates, that might reversal, that might switch to reversal. Yes or no?
Yes, yes.
So such things are, these fluctuations are to be smoothened with the help of moving average. So sometimes we take weighted moving average, sometimes we take simple moving average, most of the time we take exponential moving average. Hope the discussion topic is getting clearer.
Yes, sir. Yes.
Yeah.
Thank you, Muzammil. Thank you, Janji. Thank you, Sanesh. So this is how. And the third point says customizable weights. You have to, the weights are assigned to each data point that can be customized to fit with the specific characteristics of the time series, providing the greater flexibility. Say suppose if I give you an example, there might be two weights. Say if I say 3, there's a weightage given to 3 units and the weightage is given to 5 units. There are two weights. Suppose there are only two weights. Then in that case, you will be multiplying. See, this is the higher weight, higher, and this is the lower one.
Lower.
In this situation, my dear, say suppose you are having a point 50, 30, 70, say 15, 25. If you are having these points, so you will be only bound to take units time, 2 units time weighted moving average. Why I'm saying 2 units time? Because you are only having two weights. If you are having two weights, you will be able to apply 50 multiplied by 5. You will be able to apply 30 multiplied by 3. You know why I'm multiplying 50 by 5? Because, sorry, this is the most recent. If you go down, this is the most recent. So we will multiply higher weight to the recent one. So we will multiply 5 by 30 and 3 by 50. Is this understood? Is this point understood? We have multiplied higher weight to the recent value. Are you able to understand? Janji, Sanesh.
Yes.
Yeah, thank you. So if you multiply them, you will come out to be 50 into 3, 150. 30 into 5, again 150. If you add them up, you add up to 300. Now here, you won't be dividing it by 2 now. Why? Because the weights are itself adding up to 8. So hereby, you will be dividing it by 8. So now, you will be getting 300 divided by 8. How much should I get it for? 8 4 ja 32, 8 3 ja 24, say 60, 8 7 ja 56. So 37 point some value. So you will be
37.5.
37.5. So you are having a weighted moving average as the value of 37.5. And see, it is lying a bit near to both of these value, 50 and 30. Say suppose if you would have taken 300 divided by 2, it would be 150. It is very, very far from the data point. Yes or no?
Yes.
Yes, sir.
So always remember, taking a mean does not means that you have to divide by total number of things. It only happens when you have been told that it is not a weighted average. If it's a weighted average, and if it is like 5, 3, 7, likewise, divide by the total weights. Divide by the total weights. So that is why it is said that this is how it is calculated as a weighted moving average. And in the background, you can see, if I take this thing down and I clean this, the background, can you see the values hereby? These are the values 6, 7, 8, 9, 10. 75 is one value, 101, 86, 80, 104. Are you able to see these values?
Yeah, yes.
Yes,
Yes.
sir.
So see, we are having 72.5 as the value calculated from the last weighted moving average. And how it is done? 0.5 weight is applicable to some number at the Excel sheet at B7 value. 0.3 is multiplied by some number at the value at B6. 0.2 is multiplied by some number at B5. Are you able to understand the meaning of B7, B6 and B5? Yes or no?
No.
These are the, may I say, address. These are the address of cells in MS Excel. Now is it understood or no?
This one you have to be used by in Excel,
Yeah,
Microsoft Excel.
yes, we will be using Microsoft Excel, Abdauji.
Okay.
Okay, say suppose here you have an Excel sheet, and this sheet having this sheet is having a cell number B5, this is B6, this is B7. Yes or no? If you remember,
Yes,
this
yes.
is A, B, C, and these are 1, 2, 3, 4, 5, 6, 7. Row are 1, 2, 3, 4, 5, 6, 7, and columns are A, B, C, D. This is a very obvious in MS Excel. You guys are working professionally.
Yeah.
So these B5 contain some value. So this is the calculation of the Excel sheet. So what I mean to say now, that 20% weightage is given to the B5, the farther one. Can you see B5? Farther one. So it is given a weightage of 20%. 30% weightage is given to B6, a bit nearer one. So 30% weightage is given to the nearer one. And the most recent one, B7, it is given the highest importance as a 50% weightage. So now are you able to get it through what I am saying? The recent value shall be given a highest weightage, and the farthest value will be given a low weightage, lowest weightage, and it will decrease in this manner. So this is how we calculate the weighted moving average. And in our upcoming classes, I'll be doing this calculation, and I'll be preparing an Excel sheet which will show you that how to prepare an Excel sheet for the any type of data provided, and why we call it a data time series data. And we will be creating the charts as a weighted moving average from that data. Shall it be good topic for the next week?
Yes, sir.
Yeah.
Yes, sir.
So right today in our today's class, we have understood what is the moving average, simple moving, weighted moving average, and in our upcoming lecture, we are going to implement it on the Excel sheet. Okay. So it's a request,
Okay.
please come to your dashboard on the picture such that we can take the beautiful faces, we can capture it.
I
Okay,
think you can
thank you.
capture my picture only.
Yeah, Selma. I got it. Very good faces. Ranjit ji, be happy in life. Why are you so sad? Kunal, looking great. Okay, all the best, guys. Here I am with my thumbs up, taking the print screen. Thank you, Muzammil. Okay, Abdauji, Saud Bache has also come. Saudji, do this. Saud Bachne. Yeah, thumbs up, print screen. Thank you. Thank you so much, guys. All the very best. Hope today was an extremely value-added session. So you would have enjoyed it. And do take a recording. I think Atira will be sharing it with you. And do visit frequently to your YouTube channel such that you get prepared for your exams. All the very best. If you have any doubts, please reach out to Athira. She will be giving me your feedback. And South, I hope you must have learned something great in life today at least. If no, do let me know.
Yeah, I learned a lot of things, but I didn't understand. This is a BTech class or what? Actually,
Oh my God, this will be this is always asked question from the first candidate on the first class. So Athira will be able to help you. Okay. So okay, guys, all the best. Bye bye. We'll meet again next week. Enjoy. Have a great day. Enjoy the family.
Okay,
Bye
sir.
bye.
Thank you, sir.
Okay, thank you. Thank you.
hello, Athira. थोडी आला येत नाही. अस्सलाम वालेकुम. हेलो. हाँ अस्सलाम वालेकुम. हेलो. 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 अब आवाज येतोय. हाँ अस्सलाम वालेकुम. हेलो. अरे आवाज का नाही येतोय. हा हॅलो. अरे आवाज नाहीये. हॅलो. अरे नेटवर्कला या काय नेटवर्कलाच आहे मी. तुझा आवाज सगळं येतोय म्हणा, माझा आवाज तुला येत नाही. हे? काम नाही करत आहे. कुठे आहे अजून पण? हॅलो. अरे येतोय आता आवाज? हे? तर ते आहे मी